On Thursday, another Chinese tech giant came in with disappointing earnings. This time it was JD.com's turn. The e-commerce vendor's losses in the second quarter surged to $319 million in the period. That's 8 times what analysts were expecting. Shares of JD have now lost a third of their value since reaching a record in January as it faces more competition from the likes of Alibaba and Amazon. And overall, the tech sector in China has been under pressure. If you go into your GTV library on the Bloomberg, you can see that the valuations of Chinese tech are slipping compared to their U.S. tech counterparts. To get more insights on these results, we spoke with Shaun Rein, Managing Director and founder of the China Market Research Group in Shanghai.
I think right now JD is in trouble, actually, because of increasing competition. What we've seen in the last 6 months is the rise of companies like Pinduoduo, as well as Xiaohongshu, that are really starting to take away share from JD. JD's business model is kind of outmoded. What's happening is a lot of technological innovation in e-commerce in China, and companies like a Pinduoduo, where people talk with their friends online and have to convince other people to buy the same product. And if they do so, they get bigger discounts. So I think the big problem facing JD is competition going forward.
But are those same competitors like Pinduoduo, there's other players like VIP Shop, Xiaohongshu in China, are they eating into Alibaba's market share as well, or just JD?
No, I think Alibaba is a lot stronger. They've been able to adjust their business model. What we found in the last 3 to 4 months is the rise of live streaming TV shows, which is really popular. I actually just interviewed a 40-year-old woman from Beijing recently who's been shopping every day on Alibaba's Taobao stream because she finds that the shows are really quite interesting. So you have individuals who've opened up shops, kind of like a home shopping network, and they're selling their own product wares. So Alibaba is quite strong. JD is weaker. The other thing, Selina, to think about is there is a weak consumer market with the U.S.-China trade war starting to affect Chinese consumer confidence. What we're starting to see is Chinese consumers are shopping for cheaper items. And so they'll buy that on a Pinduoduo or Taobao rather than on a JD, because JD is typically focused on more expensive items, targeting the upper middle class.
How are you seeing the trade standoff right now impact overall consumer confidence? Are there particular companies that are getting hurt the most?
Well, I think, let me be very clear. I think President Trump is correct to criticize China. There are a lot of unfair trade practices in the country. There's far too much protectionism. Good luck if you're an internet company for trying to expand in China. You see companies like Facebook and Twitter are just banned here. But the trade war is not the way to go. What we're starting to see is China is able to offset some of the tariffs from the United States in agriculture by now sourcing from India or Brazil, soybeans, or pecans or other types of products. So you're not seeing the hit yet on the numbers in China. But if I were, say, a Starbucks or an Apple or a Macau Sands, I would be very concerned if I were in their management teams right now, because it's very likely that the Chinese consumer is going to start to protest or boycott iconic American brands. So it's a deeply unsettling time if you're an American iconic brand right now.
Have we seen that type of political risk right now for American brands? For instance, let's take Walmart as an example. They've done this partnership with JD. Is that enough to sort of shield them from these concerns?
I think it's smart to do a partnership, but it doesn't shield completely. As you saw a couple years ago, when South Korea tried to install THAAD, which is a missile defense system, China really went after South Korea. The government fanned the flames of anger in public opinion. They banned the number of Chinese tourists visiting South Korea. So actually the numbers dropped 40% year on year in April 2017. We haven't yet seen that against American companies. The Chinese government has been very measured. They've been sort of protesting against Trump's policies, but not against American companies. But I could see that happening. And when you start to get nationalism involved, and you start to see that mixed with a weak economy, all bets are off. American companies could get into a lot of trouble, even again, if they've signed up deals with Chinese internet and other players.
Shifting gears a little bit, JD's not the only company to have had difficult earnings. Tencent also had terrible earnings given these gaming licensing freezes that the Chinese government implemented. So what is going on here? Is this regulatory freeze really because of a bureaucratic shakeup, or is the Chinese government trying to assert its authority?
That's a great question. I think there is a lot of political risk in the country today. Not just the U.S.-China trade war, but I think a lot of Chinese companies are starting to get more regulatory approval problems from the Chinese government. Xi Jinping is really gaining more power and trying to enforce his views, his ideological views on the country, and that's starting to impact, say, areas like gaming, which would be moral pollution. So I think Tencent was hit hard by some of the bureaucratic issues, but actually Tencent's a great company. They're very close to the government. I expect there to be a fairly good rebound over the next 6 months. It actually might be time to buy Tencent on the cheap. I wouldn't buy JD on the cheap, but Tencent is different because they're hit more from regulatory issues rather than just a changing competitive environment.
So in a certain sense, the Chinese government has shielded companies like Tencent from outside competition. Why in this case would they be willing to put one of their national champions at risk, given the broader economic picture that's looking a little shakier now?
So, yeah, I want to pick up a word, national champion, which you brought up. The way I see it is China's government is looking to create 5 to 10 national champions in the internet space, Huawei, Tencent, Alibaba. And they're doing this because they want to control them. So they're basically going to a Jack Ma or Pony Ma and saying, if you listen to us, if you heed us 100% politically, we'll let you have great opportunities. And so they'll punish them once in a while to remind them, if you don't do what we want, we can end your business. But if you do what we want, you're going to be able to make billions and billions of dollars. So Tencent right now is working hand in hand with local governments to improve the official public administration system, whether that be booking a doctor's visit or being able to pay your bills online. Everything's going through Tencent. If it's autonomous driving, it's going through Baidu.